All right, we started the recording. Hey, it's Mike. I am not an investing guru. I'm an average guy sharing my investment journey on the internet. In today's video, we're talking about doubling your dividend income with this strategy, and specifically, not necessarily strategy, a holding. The holding I'm talking about is called QDTE. And what this holding does is instead of selling or getting paid one time a month for your covered call income, you're getting paid every week. So this changes the game. As you know, on this channel, we have very good foundational holdings, and then we borrow against those holding into income holding assets. We don't use more than 10% of our portfolio value to borrow into these income assets. So, as you know, if you can borrow money at 8% and you're getting paid 20 or 25%, that is a winning formula. So in this video, we're going to talk about the holding. So going to the holding, QDTE is a 0 date to expiration covered call strategy, and it is by Roundhill. So they recently started this in March, and consensus isn't out yet on the performance of this. Just like a lot of these income funds, these covered call funds, there's not a lot of data behind it. So what you're doing is you're using your knowledge of option investing and selling options to decide if this is a strategy that you want to utilize in your portfolio. The quick 10,000 feet view of the strategy is the Roundhill N-100 0 DTE covered call is the first ETF to utilize 0 days to expiry options on the NASDAQ 100. QDTE seeks to provide overnight exposure to the NASDAQ 100 and generate income each morning by selling out of the money 0 date to expiration calls on the index. QDTE is an actively managed ETF. So why do you want to invest in QDTE? Well, the first reason is you get weekly distributions. So the fund seeks to pay weekly distributions out of the sold option premium. Unlike yieldmax or Defiance or some of these other funds, JEP, JEPQ, FEPI, funds like that, they pay it every week. So if you're getting paid every single week, you're allowing your money to compound even faster. So you can take those distributions, those dividend payments, and you can either reinvest into other holdings or you can pay your margin out even faster. So this is a pretty game-changing type of holding. So, you know, anytime you get a faster compound rate, which more payments faster to you, that is something worth looking into. As you know, there's a high income potential. So, you know, just as a normal dividend investor in my Roth IRA, I own SCHD and SCHY, split down the middle, 50% each. And pretty much you get about 3% dividend. That is not that high. Some of these covered call funds are offering 10, 15, 20, 30, 40, 50% in income. So that's probably why you want to be looking towards it. So there's a high income potential. So, you know, they're generating high income through covered call strategy on the NASDAQ 100. And essentially, especially you're investing in the triple Q or the NASDAQ 100, is you are harnessing volatility. Therefore, if you're harnessing that volatility, you're going to get much higher payments. This just kind of goes over the holdings. I'm not going to necessarily discuss this, performance, blah, blah, blah. And the part that I want to go to is I did some calculations for you guys. So if you add all these numbers up, so it's been out since March 25th, 2024, and there have been exactly 4 payments. So with these 4 payments, it's added up to about $1.04, which comes out to about 28% annualized. So, you know, if you had invested in QQQ, you ran the covered call options yourself, or you invested in JEP or FEPI, you could be getting very similar results, but this one is slightly more, and you're squeezing out more premium because you're selling it with a shorter expiration. The longer expiration, the less premium you're going to get. But if you're selling daily options, you get more premium for that. So now, you know, we talked about just like the 10,000 foot view. We're going to actually go over the principal investment strategy. So a lot of people don't truly understand these funds that we invest in. And a lot of people have been getting hounded on the comments talking about Tesla and Tesla and how, wow, Tesla is such a trash fund. You know, it's performing the worst out of every single one. Yes, it's performing well or performing bad because the underlying is performing bad. If you invested in an underlying that's doing well, then the fund would be doing well. So what the main point I try getting across to this is when things recover, we're going to see improvement in the price appreciation as well as the dividend in Tesla. Now, going back to like the overall strategy. So selling synthetic covered calls, there are many covered call funds that yieldmax has, or Defiance or FEPI, which have price appreciation as well as good dividends. So this strategy works. A lot of people say that this strategy is stupid, that it's too good to be true. No, this is option investing and this is selling options. You can make good premium with that. I have sold options before and I have sold them on Tesla before, and the option income is insane. So if you truly know what you're doing and understand that, you understand that these funds actually are what they are. They generate mass amounts of income. Now, there's a caveat to that. If you're getting income, you're losing the growth. So that is the trade-off that you have to decide whether you want the growth or the income. Now, the reason why I borrow money into these income funds is because I want the income to pay the borrowed money. So then after the money's paid off, I have a stream of income where I didn't have to do anything for it. I would never borrow money to invest in Tesla or Nvidia or Microsoft where I'm not covering the expenses without a dividend. So just that being said, so let's go over the principal investment strategy. So the fund seeks to achieve its investment objectives through the use of synthetic covered calls that provides current income on a weekly basis while also providing exposure to the price return of the NASDAQ 100. In effectuating its investment strategy, the fund will purchase and sell a combination of call option contracts that utilize the N100 index as the reference asset. The fund will invest at least 80% of its net assets, plus any borrowings for investment purposes, in financial instruments such as option contracts that utilize the N100 index as reference. For purposes of compliance with the investment policy, derivative contracts, will be valued at their notional value. The fund's sole call options will generally have 0 day to expiration. So exactly what we were reading in the overview and in the basic web page that they had is that they sell daily options, which is 0 day to expiration. When sold by the fund at market open or shortly thereafter on every business day, the fund generally sells out of the money call options on the N100 that will expire at the end of the day. The fund's purchased call options will be struck deep in the money. And I could illustrate this point here once we're done talking. So essentially what synthetic covered calls are is you trade options. Great. So what this fund does is they may perhaps purchase a fund that's about 60 days out, June 21st. And so what they'll do, scrolling down here, is they're going to purchase a deep in the money call option. So let's see something 0.9. That's something closer to 0.9 is where they want to be. So okay, 377.78, break even 437. Strike price is 432. Essentially what they're doing is, what's happening here is they're looking for delta 0.9, maybe 1, maybe 0.85. I don't know exactly what their metrics are, but every dollar the share price goes up, it goes up 90 cents. So if you own the stock, it'll be a 1-to-1. But this call option, it's 1 to 0.9. So essentially what the fund will be doing is they'll pay $5,948 to technically own 100 shares, which they really don't. That's why it's called a synthetic covered call. And for $6,000 instead of $43,000, you can buy a bunch of call options. And so that's what they do. And then what they do is every single day, they'll sell it. So 438 was the strike price. So what they'll do to break even is they'll sell this, do this call option. So then not only will they get price appreciation from selling 438 to 377, they'll also get the $20 per share in income. So what they can do is they can scale this massively. So if, the share price is $43,000 and you're buying a call option for $6,000, you can buy a lot of call contracts to increase that income. So that is why this is a powerful strategy. So now, with that being said, so we talked about it paying every single week. So they're going to be paying you that every single week. And essentially we talked about what is a synthetic covered call. So they buy a deep in the money call option and then they sell a daily. So they buy a deep in the money call option and they sell at the money. Pretty straightforward. So essentially they're doing a covered call strategy just without actually owning the 100 shares. So then that they can scale it much more. So how am I going to use this in my portfolio? So as you know, majority of my portfolio is in Tesla. So when I borrowed my $20,000 because my account value is $200,000, now it's $128,000 because Tesla doesn't want to perform, I purchased a bunch of Tesla. So I am not taking out any more money to purchase this. So what I'm doing is with the reinvestments. So this right here. So all my different little reinvestments here, I've been kind of putting into these. So I've been putting in JEPQ, QQQI, PEPI, and QDTE. So essentially, when my portfolio does recover, there's a discrepancy because Tesla, the company, is doing great. Tesla, the stock, is not. Just keep that in mind. So what I'm going to do in my next tranche, so once my account value hits $300,000, I'm going to unlock another $10,000 worth of margin because 10% of that I would have borrowed $30,000, and that would allow me to put some money into these. So right now I just have very small positions, and what I'm doing is these are kind of my recon and scouting parties. So what they're doing is we're seeing how they're performing. If they perform well, then we will obviously put money in it. If not, then they will get dropped. So, I only have 2 shares of this. As you can see, I've gotten paid a couple distributions, got the 18 cents on the 12th, April 5th, 33 cents. So we're going to see how the strategy goes. But to kind of go back to the overall, thesis of this, this video is like, we're going to be double your income. So instead of getting paid 1 time a month from your income funds, you're getting paid 4 times in a month. So you can use that money to compound faster. So that is how we're going to be doing it. And yes, I hope this kind of gave you a little bit of a dive into this Roundhill 0-day to expiration covered call strategy. I'm just showing you what I am doing. And hopefully that helps you kind of build your portfolio, as well as shows you what is going on, or like the power of borrowing money into income funds to setting yourself up to be financially free. Now, last thing is this spreadsheet. I finally figured out how to share it. So if you guys are interested in this spreadsheet, it is going to be in the description. So go ahead, take a look at that. And besides that, y'all have a good one, and talk to you guys soon. And then, hopefully this helps you build a stream of income for your family and allows you to be financially free. All right. You guys take care.